Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is August 15th edition of Market Outlook. By the way, don't forget to sign up for this free video newsletter by going to www.marketgauge.com, and you'll receive this free every week. So more action, sideways action. Let's take a look at the Dow, which is the weak sister right now. But as you can see, what we have formed is a pretty interesting downward sloping channel. Also of note is we did get the death cross, which has gotten lots of press. One thing's for sure, when you get a death cross and the market has already sold off quite a bit from the moving average, which is the 200 and the 50, that's where your key reference point is, and you have a tremendous amount of risk. In this particular case, you're talking about almost 700 or 800 Dow points. You want to wait for a bounce before using this as a sell signal. So if the death cross and the price occur at the same level, then you have a pretty good risk reward, because when the market moves back up above the 200-day and or the 50-day moving average, you can use that potentially as an exit signal. In this case, your risk reward is pretty skewed against you. So although we have the death cross, we were already pretty well oversold, or in a pretty weak position already. So short term, looking for the bounce was something I pointed out last week. Not surprising. Now let's take a look at some of the other time frames here. What is interesting is, look, the weekly charts where the longer term trends lie, especially the 65 and even longer term the 200 week moving average. Look what happened here. We haven't really been able to close under it convincingly for a couple weeks in a row, and in fact it's still rising, and we closed above it this week, although closed, just pretty much right on it last week. So long term, even in the weakest index, we're still intact. Any severe or consecutive closes under the 65 week, and certainly under the 170 level here in the DIA, would give us what I would call a longer term sell signal, confirming what's happening on the daily charts. Completely different story with the Qs. Qs, leading tech stocks. Look at this, right? We've basically sitting right at the highs. We're maybe 2-3% off the highs. Can really see that the longer term trends well intact, and if anything, still accelerating to the upside. Look at this. The 65 week moving average is still gaining momentum, and it's gaining momentum against this rising 200 week, while the spread is also increasing. So that tells you that there's some real internal strength here in the NASDAQ 100. And again, look at the difference here. A death cross on the Dow, and look at this here. Nice bullish phase on the daily charts. You've worked into sort of this wedge formation here, so it's going to be interesting because we are sitting right at that 50-day moving average. We have not been able to close under it since mid July and later in June, but nonetheless, we've been crossing back and forth through these moving averages, and they're less significant when that occurs. What is significant is obviously this wedge shape, and the 200-day moving average, which comes in around 105. That's your true trading range. I would also be looking to watch for a breakout on the upside through this upper channel right here, or the upper trend line. So there's the disparity. Is the Dow correct? in leading the charge down, or is the Nasdaq correct here, and the Dow will recover? Somewhere in the middle is spiders, right? We had a similar scenario with a downward uh, channel somewhat forming here in the spiders. You can see from here basically to here. Let me get rid of some of these extemporaneous lines here. Okay, so there's your bigger picture. You can see that you do have somewhat of a down channel um, being projected here. It's very mildly down, so not nearly as severe. The other thing to remember is that you still are well above that 200-day moving average and basically closed right around the 50 as well. So we did close above the 50-day moving average, although it's sort of sloping down, and we're also right under the 100-day, which is where a lot of hedge fund players like to look as well. But again, you got this interesting wedge forming. Let me put that in here. Right there's your wedge pattern, and we definitely want to watch for a breakout either way of this wedge, because that could definitely be a dramatic move either way. So again, a breakout somewhere above this 210 level would be pretty interesting, because it would also bring in buyers above this yellow line, which is the 100-day, the 50, and the 10, and take out that trend line right here. So move back up to the upper end of the channel would be expected if we can get and mount enough of a powerful move through that. On the other hand, we definitely want to be concerned with a break above that low put in this week, right around that 205 level, right around here. All right, so now let's take a look at some of the market internals and see what that's telling us. And it's not going to be much. As you can see, the up-down volume and advanced decline on a 10-day basis, which is the upper chart here and the lower chart, really not giving us much of a signal for at least a month now. At the same time, the McClellan oscillator, which looks out over the next couple of weeks, 3 weeks to a month or more, totally neutral. So you can't get a read from that. If we do look at sentiment, you can see that the VIX under its 50-day moving average, also the 50 is under the 200. So overall, probably you would consider this in a bull mode. It's not overbought nor oversold, and yet the volatility is sitting under its key moving averages, and the key moving averages are stacked negatively, which works inversely for this type of chart. So overall, the sentiment is pointing to a positive environment. And again, since we're in the middle of the Bollinger Bands here that are compressing, not much can be read other than that is not either too bearish or too bullish. So right in the middle here is sort of neutral. Overall reading here for the absolute value of the VIX is a positive. Not so much the case when you look at short-term volatility versus the skew between 3 month and 1 month. The upper end here is pointing to slightly frothy. You do have the possibility of some more movement to the upside, which would be bullish for the market. On the other hand, we are hitting levels that are on an absolute basis considered a little bit rich, but we're not quite at any extreme here. So I would look at this short-term sentiment versus intermediate, which is like 3 months, this ratio pointing to a little bit of excess optimism, but not anything hugely excessive. There is more room to the upside. And so you could get a bit more of a rally based on this particular indicator. All right, let's take a look at interest rates here. Here's a chart on TLTs. These are the 20-year bonds. And this particular chart right here is pointing to the fact that we tested the 200-day moving average, moved sharply above it for a couple hours or so, rejected, and we're basically at a point here where the market is going to make some sort of significant move as the Fed has to make a decision. And it's quite mixed, right? It's hard to say which way this is going to continue. If you're really just trading the phases, you would say that the market has the bonds have moved up to the 200-day, rejected the price, and so hence we're still overall in a situation that is considered negative. So a rejection of that 200-day moving average after this significant move up is interesting. Now, we are in a recovery phase, but we did try to make it into an accumulation phase with a close or a couple of closes over that 200. It didn't occur. It seems to have failed. So again, you've got this pretty interesting, fairly tight trading range between 122 and the 126 level, and that is going to be breakouts beneath the recent low here, the last couple days, versus the highs here. That's your defined trading range, and I would follow it either way if you're not committed. Taking a look at the interest rate structure in terms of the yield curve, interesting to note that the high yield bonds are quite weak. Now, a lot of people are saying that's a good harbinger of it's a early indicator of pressure on the markets. As you can see, these yields are really rising, especially when you consider how well the 20-year treasuries have done. But again, this is sort of high yield stuff or junk. Let's put in junk as well here. And you can see that junk debt here also basically scraping the lows going back to well over a year or just about a year ago. And again, what you really want to see is that this junk debt and its spread relative to the secure U.S. treasuries narrowing, but it's widening. That is generally not good, as corporate bondholders are seen as more savvy than equity holders, and there is clearly a flight out of some of these corporate bonds and some of the junk debt. Now, the thing to remember is that a lot of this junk debt is denominated in corporate debt that is related to oil and gas. So a lot of this junk debt and high yield corporate debt is under extreme pressure as the commodity markets, especially oil and gas, is under tremendous pressure. And those companies that borrowed on the margins are risking bankruptcy and defaulting on that debt. So a lot of this debt here is related to oil and gas in these high yield plays, and that is putting pressure on these prices here. So the question is that going to be a good indicator like this particular these particular instruments were in early 2007, 2008, before the financial crisis? and the jury's still out on that. To me, it's a big if, because it's unclear whether general corporate America outside of oil and gas is actually under pressure. And from other charts I've looked at, that's not the case. So this is lots of pressure on these particular ETFs because of oil and gas. Okay, so let's take a look at gold, and let's go to a different set of instruments. So on the daily charts, obviously, right, gold went into a death cross in 2014. It sort of renewed a nice rally, which it could not sustain. So recently, we definitely had a dramatic sell-off. A lot of people are projecting much lower prices in gold. Right now, you have a key reversal pattern that's still sort of in play, right? You had a pretty good size blow off on the downside, and we've had a decent recovery. What I would really like to see is the 50-day moving average flattening out. It's still dropping sharply. So what I'd like to see is that 50-day moving average flattening out or starting to rise before I say that the current leg down in gold is over. So short-term correction within a longer-term down move, and we really need to get at least above that 110 level as well. What is critical is that the recent lows here are held. Let's take a look at what those levels are. Down here, you're talking about the 103 level is pretty important for gold to hold. Otherwise, we can be in a situation where the market could certainly break 1,000. Although a lot of people are calling for 1,000 to hold, if you look at the longer term channel in gold, you'll see that it really comes in quite a bit lower. You're talking in the $800 or $900 range by the time we get there. So you can see this is a nice downwardly sloping channel. The 65-week moving average, which is really the longer term trend, we would really have to get above 117 level and that downward channel, because you can see how this coincides. So a move above 117, you would know that this tremendous move down in gold is over with. Short-term pops, certainly possible. Back up to the resistance level around 110 would not be surprising. And that's sort of what's in play here. Also, the speculative money, for the first time since 2006, still net short gold. So that is highly unusual as well. All right, well, again, markets in that sideways, choppy action overall. The leading market, the NASDAQ, and especially the NASDAQ 100, still nice, strong trend intact, led by the leading stocks. They're really outperforming the overall NASDAQ. They're really, really strong. The Netflix, the Amazons, Google. So all the top stocks continue pretty much to lead. And so very mixed bag, and it's really hard to say which way the Fed is going to move here. And obviously, that's putting a headwind into the market as well. So let's keep an eye on those TLTs. Obviously, a move either way, a couple points either out of this sideways trading range for the last couple weeks will probably be a deciding factor, certainly for the next several months going forward. All right, have a great weekend. Summer's winding down, and make sure you enjoy that as well. Thanks, and see you next week.